So let's start with alternative investments. What are alternative investments? Alternative investments are not just private equity or real estate. CFA groups them together because they are simply different from traditional assets like public stocks or bonds and cash. To go about the definition of alternative investments, I would say that it is the uh, investments that are other than owning traditional asset classes like public equity, fixed income instruments, and cash. To differentiate between alternative investments and traditional investments, we have a table here. Examples for TI is public stocks, bonds, cash, whereas for alternatives, it is private equity, real estate, hedge funds, infrastructure, commodity. Traditional investments come with high liquidity, so you can sell them anytime you want and mm, buy them anytime you want during the market hours, at all times. That is, they are highly liquid. But alternatives are illiquid, and it might take you months and years to exit from a particular fund or real estate or private equity if you own it. And pricing evaluation are much efficient in traditional investments. They are daily mark to market, but whereas in alternatives it is infrequent and haphazard. And traditional investments are highly regulated by the securities boards, SAB in India and SEC in USA. But regulation is lower in alternative investments, providing much more flexibility to the managers to generate the alpha. Historical data is abundant and unbiased in traditional investments. You see a lot of research analysts working on a lot of traditional investment assets, that will help you derive value and decide upon the investments that you should be going about. But in alternative investments, the data is very limited and often very biased towards the funds that the research analyst would recommend you to invest in. And coming to fees, they are lower in traditional investments, and alternatives have higher fees, and you have a typical 20 by 2 by 20 structure where 2 stands for the management fees and 20 for the performance fees that the fund manager would charge you. The manager role is limited in traditional investments. Sometimes, if it is a passive fund, it is simply a ETF, a fund which would simply try to mimic the uh, index. But if it's a even if it is an actively managed fund, the role of the manager is much limited when it is compared to alternative investments. Here in alternative investments, the manager will have a niche and narrow specialization, and they would use heavy leverage to generate alpha for you. Alternative, to summarize the differences, alternatives are in less efficient markets and have the potential for higher returns, but they have their own trade-offs. Features of alternative investments. No, this is the core of today's lecture, that we'll go about each one by one. Let narrow manager specialization. So the skill of the manager is everything. So what the fund is, the fund generates the returns is based on the skill of the manager, and they offer true diversification, and they are less regulated and less transparent, and they come with a lot of bias, survivorship bias, backfill bias, because these are not very transparent, and they are not regulated as much strictly as traditional investments, because there has to be some freedom to the manager to be able to return the alpha. So high fees. So since the funds are working on uh, generating the extra returns, they are, of course, they come with typical high fees, uh, which I talked to you a few moments earlier. And there is one more type of fees, that is 1 by 10 structure, but 2 by 20 structure is the norm in alternative investment space. Of course, they make use of leverage to amplify your returns. And you have redemption restrictions. So you have a certain lockup period, especially in hedge funds. So you will not be able to take out your money whenever you want. And this attributes to the illiquidity of alternative investments. So to summarize the features of alternative investments, they come with longer horizons. So if you are a long term plan, you have a long term plan, and you are a high net worth individuals, then alternative investment is for you. Okay, longer horizon, and they come with illiquidity premium. For the premium, for affording to have an illiquid fund or investment, you are getting the illiquidity premium. So the extra returns, whatever that's being generated over the traditional assets, that is called illiquidity premium. So investors demand extra return for locking the money, for having illiquidity. For having illiquidity, investors do demand extra returns, so that is called illiquidity premium. So there are three broad categories under alternative investments, that's private capital, real estate, and hedge funds. Private capital is further classified into private equity and debt. Real estate is classified into infrastructure, that is uh, roads, highways, railway projects, buildings, natural resources like farmland, timberland, and so on. So to make sure we understand what we learned, why is real estate or crypto alternative called alternative? Because of the illiquidity and valuation challenges that real estate and crypto offers, it is classified under alternatives. Coming to understand go about alternative investments and traditional investments once again. Traditional investments have an efficient market, whereas alternatives have an inefficient. But the return potential is low in traditional. But in alternatives, we have higher expected returns, and they all offer true diversification. And traditional investments, the pros of traditional investments are high liquidity, transparent pricing, and abundant data that's available to do the research on the investment products, and also they come with low fees. Here you get illiquidity premium and the manager specialization that would help you beat the returns of traditional investments. But again, in tradition alternative space also you have certain trade-offs, that you are having illiquid instrument, and you are paying high fees, and also having complex valuation, and there is the risk of manager. So there is a higher risk of um, uh, incurring losses when it is compared with traditional investments. So to quickly wrap up, I will let's go into the quiz. What is not a common feature of alternative investments? High fees, is it a common feature? No, because this is a high fees uh, is a feature of called alternative investments, and low correlation is also a feature of alternative investments. Daily mark to market is a feature of traditional investments. So this is the answer. What is not It is not a common feature of alternative investments. Daily mark to market. So daily valuation, pricing evaluation will not happen in alternative space. That only happens in traditional investments. Why are alternatives grouped together? Why alternatives are grouped together? Because they are distinct from traditional investments. How they are distinct? Because traditional alternatives have mm, are illiquid, liquid and poses valuation challenges that is not seen in traditional investments. So to finally wrap up the session, if you want to take only one sentence from this session, that would be alternatives are of higher expected return plus diversification, but you are paying for the higher return with illiquidity, high fees, and the complexity involved in alternative investment products. So thank you. That's it for the LM1. I'll come up with LM2, and I'll share you the notes of this in the description box. Thank you for listening. Hope you have a good day.